Look, the main point is simple. The market needs to stop waiting for interest rates to return to zero. That word is probably gone. For a long time, investors were betting on a very comfortable story. Inflation would slowly disappear, central banks would cut rates, liquidity would return, and everything would return to the old bull market playbook. But that story is breaking down, my friends. The reason is that disinflation is not just about governments spending too much money. It is increasingly connected to physical constraints, energy, commodities, shipping routes, and the geopolitical risk. A central bank can raise or lower interest rates, but it cannot create oil or gas or reopen a blocked trade route. So when the energy costs rise and global logistics becomes more expensive, inflation becomes much harder to control. And that forces central banks to stay tighter for longer. It also strengthens the dollar, pressures other countries, and forces these other countries to raise rates defensively, even if their economies are already slowing down. The consequence is very important. The cost of capital has been repriced. So the message is that we are not just seeing normal volatility. We may be seeing a transition to a road where money has a real cost again and investors needs to adapt to that. So keep things simple, trade safe, take care, ciao ciao.